Let's now connect with Rahul Chadha, Co-Chief Investment Officer with Mere Asset Management. Rahul, last time when we spoke to you, you said you were not bullish, but you were very bullish on India. So far, your call has played out. But given the rally from the recent lows, about 10% on the index, 15, 20 to 25% in mid and small cap stocks, do you think now markets are fairly priced and the next move will only come if the economic recovery becomes clear?
Okay. So if we look at what we kind of said last time around, we were constructive. So I think the message was that, look, all around the pessimism was so pervasive that one realized that there was an opportunity in terms of mispricing in markets. And that's where if the policy response came from government, obviously one would make money over there. Risk reward was favorable. Before we talk about India here, just give me 30 seconds to talk about what's happening globally. So what we've seen is ECB's expanding the balance sheet. We've seen Fed, which is expanding the balance sheets. Ahead of the US elections, 12 months from now, we've seen a temporary truce between the US and China. So clearly all these factors which were on mind of global investors, all these concerns are are abating. And if you see the flows this year, close to 200 billion, 230 billions moved out of global equity funds. Risk aversion globally is very low. Risk reward in terms of investing in EMs Asia is favorable. So with that as a backdrop, I think one remains constructive on markets. But then coming to India specifically, obviously, there are parts of markets which we've said in the past, consumer names, etc., which are expensive. And now we're seeing earnings rollover from these names. So because these are great companies, what they'll do is go through a period of time correction, correct 5-10% over the next 12 months. But I think there are pockets of opportunity in financials. So well-managed corporate banks, insurance, despite the good run-up, I think pullbacks would be bought into that sector. Utilities, some of the PSUs have not participated. So if the government gets its act right on unlocking value from these non-strategic assets, I think there is big money to be made in PSUs.
I'm going to pick it up from where you left, PSUs. Now, my experience of tracking some of the global funds is that global investors normally, they love to hate Indian PSUs. But you are making a case that at this current level, if a BPCL disinvestment happen or SCI disinvestment happen, you will be open to buy PSUs.
See, there are great companies, but those great companies may not be good stocks when you're buying them 40, 55 times earnings, 45 to 50 times earnings, 18 months out. And in a period where nominal GDP is not going to grow at 15%. See, this is something we've said time and again. We are in a slower for longer world. Growth rates have to get realigned. India, which used to grow at 7-8%, real GDP nominal going to 14-15, will probably do a 5-6% best case, nominal GDP going to 9-10%. So within this paradigm, you've got to find businesses which would be relevant 5-7 years from now. You have to see where risk rewards are favorable. And that's where some of these reasonably well-run PSUs with an added optionality of government looking to divest become attractive.
Rahul, you've always said that, look, I buy Indian companies because there are great corporate governance standards here. The return on equity, the return on capital is one of the highest in the world. But given what we've got given what we've got from corporates on how levered their personal balance sheets are, how their capital allocation has been rather poor. Do you think somewhere this entire corporate governance premium, what Indian markets, Indian stocks have historically commanded, that will get challenged?
See, it works on a stock-specific basis. So we've seen certain private sector banks get re-rated as they manage this NPA cycle well. So the governance levels have improved over the years. At the same time, we've seen certain entities where the governance issues have come to the forefront and those names have got re-rated. So I think market is smart, discerning enough to act on this from a case-by-case basis.
Okay. Rahul, given that, given, of course, that Reliance is one of the names in your basket, I just want to talk about all the recent developments there, the fact that they're, hiving off Jio, taking the debts onto the books of the holding company, big plans, of course, and today coming out with a tirade against some of the incumbent telcos and that ongoing tussle, of course, continuing there. The Aramco deal is one that's still a question mark. We don't know if it's going to come through, but of course they're counting on that. Given all the recent developments in an RIL, just how you're perceiving them, what you feel is going to be the outlook for the company over the next few months, how positively you're looking at some of the developments in Jio, or are you watching out, to wait and see if the Aramco deal comes through?
Okay, so a couple of points underlined. So if you see what they've done over the last 2-3 years, it's commendable. The way they've built the telecom business, the way they've built the retail business. And I think there's a huge headroom for growth in both these businesses over next, 3 to 5 years. They also benefit from IMO coming through and better refining margins over next 12 to 18 months, obviously. So these are the positives. The negatives, obviously, is the stressed balance sheet, which is where you would want a part of a deleverage either through some stake sale to a strategic partner, etc. So that should be positive. So one is watching that space closely. So I think that's the point. And the very fact that stock's done well, it is highly likely that it takes breather for couple of quarters before market gets more clarity on these growth businesses, which is digital and retail.
Rahul, I wanted to get in your take as well how you're looking at the overall telecom space, given the kind of news flow that we've seen so far, the fact that it's nothing but dues and debt repayment from some of the players. Of course, there has been consolidation. What's the way ahead? What should shareholders within a Bharti and now Vodafone Idea, which has been reduced to a 4 rupee stock, be doing with their investments here?
Okay. So I think what's positive is that the government's acted very quickly after the Supreme Court judgment, because look, monopolies never help a country from a longer term perspective. They are not beneficial. They're not beneficial from a consumer from a medium term perspective. And I think that's what the government realizes, which is where this committee of secretaries being formed, and which is looking into the fact that, look, how do we kind of revive and make sure that, look, it remains more than 1 or 2 players sector, basically. So I think one is positively inclined towards that. And now with the 3-player market, it's a fairly consolidated market. And one is hopeful that in due course, kind of an fair pricing comes to the market and the overall revenue pie grows, basically.
Also, last 10 years or last 15 years or even last 20 years, one trade which has really worked in India is that you bought into private sector banks. The thesis was very simple. We both know that, but I'm speaking it for the benefit of our viewers, which is that Indian PSU banks, they lost market share. They did not have great governance standard, and Indian private banks were able to gain disproportionate amount of market share, and they had good governance standards. So for next 5 years or 10 years, what do you think that secular trade could be, where you would say, look, I will not worry about today, tomorrow. I will not focus on the recent valuations, but I would buy them because I think this is a value migration or a great secular theme for next 5 to 7 to even 10 years.
Okay, so I think the private sector bank trades continue, though what I may say is names which are a bit expensive above their mean valuations may compound at a slower pace, because like what we discussed before, nominal GDP growth rates may be slower than what we saw in last 10 years. At the same time, there are candidates where we've had change in management which are putting the best practices in place. So there's a room for these candidates, some of the private sector banks to re-rate. So I think that's where you make money in the space. Insurance looks promising. Again, I say that, look, we've just seen the beginning of this kind of an affinity for the term insurance, and it's extremely profitable. So we are still in year 1 or 2 of this cycle. So I think that can be something which stays for 5-7 years. And then there are pockets of consumption. See, again, consumer staples were expensive in India. They had huge market caps. But some of the discretionary consumption names are still small, and we've not really seen demand pick up for these names. We've not really seen the benefits of GST gains for these names. So they can play out. And finally, again, one is hopeful on the investment demand front also, that look, for 10 years, we've not really seen any significant investments in the economy. Post the go, no-go areas, which happened in 12-13, businesses have been reluctant to invest. So today, if we look at the Indian tax rate for new investments at 17%, is the lowest in the region. So with manufacturing looking to move away from or looking to diversify away from China, India suddenly comes as a very attractive base. So if we get our act on the investment cycle right, I think there is money to be made there.
It could be that big thing which you think could be produced out of India, where we will have an advantage. I mean, auto is the only sector where I think there is little bit of export potential, but rest of the sector, including, I mean, I don't see India has become a great Makkah or a renaissance of manufacturing at all.
Okay, have a look at the electronic exports. Even we were surprised when we saw the number pick up by close to 60% last year. I mean, if I'm not mistaken, Foxconn would have close to 40-50,000 employees in India. Who thought 3 years back that an iPhone would be produced in India? So I think very often we underestimate the lure of a huge captive domestic market. And when you juxtapose that with the attractive tax rate, suddenly it becomes a very attractive proposition for businesses who were till now sourcing close to 60-70% of their global production from China to put an alternate manufacturing base if this US-China trade war continues.
Where do you think the HULs, the Nestle's, and the Britannias of the world are headed? I mean, these are companies which will not cease to exist, irrespective of the disruptive environment we are in. But for shareholders, are we in for a 5-year, 10-year single-digit return? I mean, are we reaching that decade of no return or single-digit return for some of these staple names now?
Absolutely. See, if we look at the sector, what's happened is we've seen smaller players already fall by the side, and the investor interest has converged in these top 2-3 names you're talking about. But these guys are also struggling to beat the estimates. I mean, the most of the beats which has happened this quarter is because of tax cuts. The base is high. And look, the margins are 5-year high. So very often what happens is the big mistake market participants do it. We extrapolate what's happened in the past in a very linear way. Whereas when you sit down with a business owner, you realize that life is a lot more tougher. So I think it's highly likely, because these companies are the best in the sector, they may just compound for next 5 years at about 4 to 5%, and then the valuations get reasonable, and then they move on to the next level of growth.
Rahul, let's talk about cyclicals as well. I don't see them in your basket as of now. Would that be an area of the market you would start to look at these levels, and with an eye to, the macro picture and how we are expecting growth to pan out?
Okay, so there would be 2 things which would kind of move cyclicals. One is China's FAIs or fixed investment spends. We've seen some pickup in that, but look, PBOC, which is the central bank in China, is reluctant to throw large-scale stimulus in the economy because they're very constrained or mindful of the fact that debt to GDP is fairly high in the economy. On the other hand, globally, we've not seen any signs of an investment cycle pickup. So if we see Germans looking to do a $400 billion stimulus in Eurozone, or the next government in US looking to do a large-scale stimulus to an infrastructure boost, that's where cyclicals kind of take a significant uplift. Till that time, I think it's going to be more of a local cyclicals, cement doing well if housing picks up, if investment cycle in India picks up.
Rahul, frankly, the Nifty has given good returns in last 1 year. So how tough it is for you to now beat the benchmark? I mean, Nifty, because of variety of factors, has managed to beat the, managed to give a good return. But next 2, 3, 4 years, what kind of world are we headed towards?
So I think what happens, Nico, this is something we discuss internally in the team. The key thing is not to suffer from the multiple deratings as and when it happens in the stocks, because that can be very painful. So stay disciplined in terms of the businesses you're choosing. Keep your discipline on valuations. And I think that's the simple mantra for active funds to beat the benchmarks. If you go with the fad, if you go with the expensive, well-loved names, it's highly likely that you underperform the benchmark.
So, Rahul, the favorite question, perhaps the most painful question, active versus passive.
Well, there is always a room for active. Again, the way we've navigated this big challenge we get from passive is by running relatively concentrated funds. Our country funds would be no more than 40 stocks. Our regional funds would be 50 stocks. You'll see huge deviations. Like in the Asia fund I manage, India would be overweight by close to 15%, but we'll not have much of the expensive Indian consumers. You're looking at some of the Indian utilities, etc., which are cheap businesses, which are going to be relevant 5-7 years from now. So I think, again, we come back to this. The way for active to survive is be disciplined on the business models you're backing, be disciplined on the valuations you're paying, and eventually market will take cognizance of that.
Rahul, one important feature which has helped the market and has stemmed the fall is interest rates. Interest rates both locally and globally have come down. Especially in India, the rate cut has been quite rapid. Now, we may see more rate cuts. It could be 20 bips, 25 bips or 50 bips. It's not going to be 100 bips or it's not going to be 150 bips from here because your cost of borrowing in India is very high. So if one works with an assumption that 3 months or 6 months from now, we are nearing the end of the rate cut cycle in India, what do you think that will do to valuations, and especially for sectors like utilities, which in a sense have managed to outperform because of rate cuts?
Okay, so I think when we are talking of utilities, we're not really buying them for rate cuts. If you look at something like NTPC, earnings growth are still, or GAIL, earnings growth are still going to be anywhere 10-15% for next 3 to 5 years. And unlike the regional or global utilities, which would be up 40-50%, these names are down 30% because of this overhang of government stake sale. So if government finds a better way, which we've always said that government should do, of privatizing the non-core SOEs or public sector units, that reduces the pressure of this unabating stake sale in these utilities. And I think that should be a positive re-rating for the stock.
Rahul, we've talked a lot about where we could possibly see value unlocking, but let's talk about the risks as well. This is all dependent on, of course, things moving along with regards to the investment cycle, the government's measures to kind of streamline things, boost growth, and so forth. Do you feel, how confident are you that we're going to see things really only get better from here on? The next big trigger, of course, is budget. We've already seen a whole host of measures announced by the government. So, sort of, we don't know at the moment whether we'll hear more before the budget for sure, which is still a few months away. What's your sense?
Okay, so clearly seems like the worst is behind us, though the pace of the recovery would be contingent on a couple of things. If you ask me for the risk factor, clearly the fiscal space with government is limited. We've seen some cuts here and there, but I don't think they've got room to do much beyond that. So which is where you need these privatizations to fill in the gap. And the second issue is really the confidence in the financial system. So if we want a quick recovery, if we want a recovery over the next 3 to 4 quarters, it may not be a bad idea to have a mini top and buy the assets from all these questionable, vulnerable entities so that the business is so that the system is confident and they can go back to lending again. So I think the financial system confidence is really one of the key factors which is going to determine the pace of this recovery.
Rahul, what is your sense on this entire promoter leverage challenges which have come to fore? Best of the names which we've always admired, and we've kept those businesses at a pedestal because of the vision of the promoter, their ability to manage risk and the ability to do smart capital allocation. Question marks have been raised there. Do you think we are in more for unwinding pain at promoter level, given that the infrastructure sector in India, the real estate sector in India is in a doldrums, more and more skeletons will come out of the cupboard?
Okay, so you've raised an absolutely great point, and this is something we discuss with all promoters, entrepreneurs, when we are looking to invest in these businesses. Jokingly, we say that, look, in India, the meter runs at 12-13%. So if your projects are late by 2-3 years, your entire equity contribution is almost wiped off. If you don't get the utilizations you've baked in your initial estimates, it can play havoc with your P&L. So I think that's really very important, and which is where the assumptions which are running for a 15% nominal GDP growth will get moderated. Some of the weaker hands will obviously fall by the side. But if the businesses are good, we've seen that, look, market participants, whether it's private equity, whether it's the our universe, listed universe, we're willing to fund those good businesses. But look, I think this is something most promoters have to keep in mind, that the cost of capital remains fairly high in India, and which is where your assumptions need to be reasonable. You've got to build in reasonable margin of safety that your sales may not materialize the way you expected in first place.
Net, next 1 year, will it be reasonable to expect that we are in for a 10% return both for the Nifty and mid and small cap stocks, or you would say 15? If I say 15, I'm being bearish.
No, I think 10 to 15 is a fair number. What you will see is market leadership change, and I think that 10 to 15 is contingent on new set of stocks coming and taking this market further. So apart from this big quality kind of an bubble we've seen over 7-8 years, if we see new set of stocks emerging, and which is a function of investment cycle picking up, which is a function of government choosing the right path to handle this fiscal deficit, which is bite the bullet and do your privatization of public sector units. You will make money in the market. But if the government takes the easy path and is not willing to back tough decisions, one should be mentally prepared that market may be flat or even down from here.
Thanks very much, Rahul, for joining in and sharing with us your outlook on the markets as well as your sectoral preference.